Today, we're going to break down a recent article from the Toronto Star that's created a ton of buzz in the Airbnb world, especially here in Canada. The article covers a new tax ruling that could impact really anyone who's been consistently renting their property on Airbnb or similar short-term rental platforms. If you've been using your property as an Airbnb or a short-term rental, or you're thinking about getting into the short-term rental game, you'll definitely want to stick around for this one because there are some serious tax implications you definitely need to know about. In this video, I'll walk you through exactly what the article says, break down the details of the case involved, highlight key points from the CRA website to clarify things directly, and explain why, for most Toronto Airbnb hosts, this ruling may not be as concerning as it seems. What's up, everyone? My name is Fady Nakhla. I'm a real estate broker right here in Toronto, and my passion is helping people navigate the ins and outs of the Toronto real estate market, whether it's buying, selling, or investing. If you've been on my channel already, you know I've done a ton of work with my past clients with short-term rentals. So if you are thinking about getting into the world of Airbnb or short-term rentals, or if you have any questions at any point in this video, you can reach out to me using any of my contact information below, and I'd be more than happy to help. All right, let's dive right into the article. So the headline reads, homeowners who regularly rent on Airbnb and other sites must pay 13% tax on property value when they sell. Recent tax ruling finds. So this sets the tone right away. The Tax Court of Canada has ruled that if a property has been consistently rented out on a short-term rental basis, the CRA may apply a 13% HST tax to the sale of that property. And just to clarify, this isn't talking about the HST that Airbnb collects on individual bookings. This is a tax applied to the actual sale of the property if it's been used primarily as a short-term rental. This means that if you sell your property for, say, $1 million, you could be looking at a $130,000 tax bill just from HST alone. For those of you who've been renting out a condo, townhome, or even a single family home on Airbnb or VRBO, this isn't just a minor rule update. This is something that could seriously impact your bottom line when you go to sell. To understand this better, the article explains a specific case involving a condo owner in Ottawa, and here's the situation. The decision was made in a case where a condo owner in Ottawa sold his home after renting it on Airbnb for periods of continuous short-term rentals for 14 months prior to the sale. So this condo owner owned this investment property in Ottawa and initially rented out his unit through traditional long-term leases for 9 years. But in 2017, he listed it on Airbnb, renting it for short-term stays over a period of 14 months leading up to the sale of the condo in 2018. So it sounds like he was doing short-term rentals for a little bit over a year. I'm not as familiar with the Ottawa short-term rental bylaws, but if I recall, they are very similar to Toronto. So that scenario wouldn't even be possible anymore with principal residence requirement, and you'd have a 180 night limit per year. Okay, so back to the case. So he assumed it was still a residential property and didn't pay HST on the sale. However, the CRA assessed that since he was using it like a hotel, it was furnished with utilities included and rented short term, it should be taxed as a commercial property. The seller appealed this decision, but in March of this year, the court determined that at the time of sale, it wasn't a residential complex, but rather it was commercial. So the entire sale price of the condominium was not exempt from HST. So typically when you sell a property that you've been living in, it's considered a residential sale, and it's generally exempt from HST, or HST is included in the sale price. And this applies to when you're buying as well, right? So if you buy a property for $1 million, that's what you're paying. You're not paying $1 million and then 13% HST on top of that. And then the same thing goes for the sale. Say you sell that same property a few years later for $1.1 million, you're selling for $1.1 million flat. It's not 1.1 and then 13% on top of that. Also, if you've been renting out your property to long-term tenants the more traditional way, it's also still considered a residential sale and also exempt from HST. However, because the unit was being rented out on a short-term basis through Airbnb and the CRA classified it as commercial rather than residential, the seller was now required to pay 13% HST on the entire sale price, just as you would if you were selling a business. So to dig deeper into this, I went straight to the CRA website to see their rules around commercial use for vacation properties. Here's what they say. The purchase of a vacation property is also taxable where the property is not used primarily more than 50% as the vendor's place of residence, and all or substantially all 90% or more of the rentals of the property are for periods of less than 60 days. So in simple terms, if your property is rented short-term for more than 90% of the time, the CRA considers it a commercial property and HST may apply to the sale. However, if the property is primarily your residence, meaning you're using it more than 50% of the year as your home, then this rule generally should not apply when you sell. Now, for Airbnb hosts in Toronto, this actually lines up well with Toronto's short-term rental bylaws, and maybe that's why the bylaws are the way they are. But Toronto's rules state that to legally list your property on Airbnb, it must be your primary residence, and you're limited to renting it out for a maximum of 180 nights per year as a short-term rental. This is just under 50% of the year, meaning over 50% of the time, or 51% to be exact, it's being used as your residence. So following Toronto's guidelines puts you safely in the residential category because you're meeting that 50% residential use threshold. According to the CRA's classification, if you're using that property as your primary residence for more than half of the year, then you're likely exempt from this 13% HST ruling. In other words, if you're renting out your property no more than 180 nights per year on Airbnb, this tax should not apply to you when you sell. So going back to the article, the next part, it says the ruling indicates that when the sale occurred, the property was an Airbnb and therefore subject to the tax, suggesting that if a home is converted back into residential use, it's unlikely to have been taxed 13% HST upon sale. So this part of the article suggests that if you convert your property back to residential use before you sell it, you might avoid having to pay that HST. But honestly, I didn't find any mention of this on the CRA website, so these rules still have some gray areas. I'm not sure who wrote or said this part of the article or where this is coming from exactly, but as of now, there's no concrete definition of how long the property would need to be used again as a residence before the sale, or what that conversion process would really look like. So if you're thinking about selling after using your property as a short-term rental, I definitely recommend consulting a tax lawyer to get a clear guidance on your specific situation. Now, this ruling really matters most and is most relevant for those of you who own multiple Airbnb properties or have vacation homes in areas like cottage country like Muskoka or Blue Mountain, for example. If you're renting out one of these properties consistently for short-term stays close to 90% of the time, that's where the CRA might step in and apply this tax. So if you're managing multiple units as short-term rentals, you definitely need to keep this ruling in mind. And again, just a quick clarification, this tax ruling on property sales is different and has nothing to do with the HST you might need to charge on Airbnb bookings. When we're talking about HST due on services such as short-term rentals, again, going straight to the CRA website, the CRA considers you a small supplier if you're making less than $30,000 in gross revenue from Airbnb. And in this case, you don't need to register for an HST number. If you do make anything over that $30,000 threshold in the last 4 consecutive calendar quarters or 1 year, you should be registered for HST and charging HST or 13% on all your bookings. Currently, Airbnb does offer an option to collect and remit this HST on your behalf, but this is separate from the HST on property sales that we're discussing right now. And it's worth noting that this isn't something you can easily bypass. The CRA and Airbnb have both been cracking down on short-term rentals that don't comply with these rules. The CRA wants to clamp down on what they see as leakage. In other words, they're looking to ensure tax revenue from real estate transactions is being fully collected, whether it be from capital gains or assignment sales, or in this case, the HST due on a sale of a short-term rental. So if you're tempted to sidestep these rules, I would advise against it. The risks are high, and getting hit with a retroactive tax bill or penalties, just like we saw in this case, could be very costly. Again, my goal here is to give you all the facts so that you can make the best decisions for your own situation. I think the headline of this article stirred up quite a bit of concern. I personally got a lot of messages about it. While I don't think they were trying to fearmonger or anything like that, the headline definitely had a little bit of a clickbait feel to it. Maybe it was just a slow day in the newsroom and they needed something to report on. I'm not sure, but at the end of the day, real estate news, especially in Toronto, does sell. So that's definitely something to remember. So to sum everything up, if you're running an Airbnb in Toronto, using it as your primary residence and following the 180-night rule, you likely don't need to worry about this HST tax when you sell. This ruling is aimed more at properties that are operated like vacation rentals or mini hotels all year long, rather than homes that are primarily residential with occasional short-term rentals. And remember, this isn't a new rule. It's been around for quite some time. This particular case was definitely unusual and a bit complex, especially since the property had been rented long-term for nearly the entire ownership period, with only 14 months of short-term rentals before the sale in 2018. The seller didn't pay HST at the time, but after a lengthy process, the final court ruling only came out this past March, which highlights really how complex this situation was. That said, if you're unsure about your specific situation, or if your setup is a bit more complex, it's best to speak with a tax lawyer to ensure that you're fully compliant and don't face any unexpected surprises down the line. And as always, if you'd like a second opinion or want to chat about how this might affect your Airbnb property in Toronto, I'd be more than happy to connect. My contact information is all below, so feel free to reach out to me anytime. Thanks so much for watching. If you found this video helpful, please hit that like button and don't forget to subscribe for more insights on the Toronto real estate market and Airbnb regulations. If you do have any questions, drop them in the comment section below or reach out to me directly if you want to discuss anything Toronto real estate. I'm here to help. I'll see you guys in the next video.